Yes, it's recording now. All right, welcome everyone to the third webinar of the webinar series on endogenous money, which is being organized by the Keynesian Economics Working Group in collaboration with the Financial Stability Working Group. My name is Devika. I'm an organizer for the Financial Stability Working Group and a PhD candidate at the University of Massachusetts in Amherst. Several of my fellow organizers are online. Miriam is online, Lillian is online, Ayosa is on, I think he's online, maybe not, I'm not sure. Anyway, today we have with us Professor Josh Mason, who's an assistant professor at the John Jay College for Criminal Justice. He's also a fellow at the Roosevelt Institute. Also a graduate from our program, so I'm very excited to have him here on this webinar. He's been the policy director for the New York State Working Families Party. Lately, I personally enjoyed reading his blog a lot, and well, partly because of that, we've invited him to talk to us about endogenous money today. So without further ado, Professor Mason, the floor is yours.
All right, well, thanks for that introduction. And I should add, at John Jay, we do have a new master's program in economics with a heterodox approach. I don't know what mix of people are on the call here, but if that's relevant for you either as a student or as an instructor, then you should definitely be aware of that. What I want to talk about today is monetary policy, a little more perhaps policy focused than some of the other talks in this series, not necessarily because monetary policy itself is so important or because we want to imagine ourselves as central bankers, but because I think that is the space where a lot of the most interesting discussions of macroeconomics take place today. It's where, in a sense, where in the established world of policy orthodoxy, where macroeconomics happens is at central banks. And I think it's also the place where the lack of congruence, the lack of fit between economic theory and economic reality becomes most acute. If you imagine fitting a sort of flat map over a globe, you're going to find it's going to crumple up or not fit somewhere. And central banks sort of sit at some of those most important crumpled points or tears. And that's not a coincidence. In a way, that is the function of central banks, or one of them, is to cover up that lack of fit between the sort of economic ideology and the reality of economic management. And I want to just say just a bit about that before I get into the substance of what I want to talk about today. It seems to me that if we look at economics, we see a real divide between the sort of economics of ideology that's taught, to undergraduates, but also is the sort of real, pure academic macroeconomic theory, which is this vision, as we all know, of this decentralized, self-regulating system where you have rational actors who arrive, spontaneously at this sort of optimal outcome. This vision, and then the actual experience of the economy that anybody involved in economic policy or in the business world has, which is a complex, unstable system that requires active, conscious, centralized management for any kind of stability or acceptable performance. And I think central banks, in a way, really function today to sort of manage that contradiction. They reconcile it with sort of two sets of ideas about monetary policy. One is that what policy is doing is simply restoring the sort of natural state of the economy. And obviously this language of natural rates of interest, natural rates of unemployment is everywhere, and it definitely has an ideological function. The central bank isn't actually doing anything. It isn't consciously directing the economy. It's just restoring some sort of pre-existing natural harmony. And this is quite explicit, of course, in a lot of the discussion. You'll definitely find plenty of prominent economists who say, well, in some sense, the interest rate is just restoring what we would have in the free, Simon Rand-Lewis, Paul Krugman, all these guys will talk this way. We're just restoring the natural interest rate or the natural unemployment rate or whatever it is that you would have in this sort of, abstract system of exchange. And if you go back, to Milton Friedman's famous speech on monetary policy, the use of monetary policy, he's extremely explicit about this. What is the natural rate of interest? What is the natural rate of unemployment? He said, they're just the rates that would be ground out by the Walrasian system if that system could somehow incorporate all the institutional and social facts of the economy we actually live in. Now, obviously, it doesn't make any sense to talk about this mathematical system incorporating institutional and social facts. But it's that contradiction, which is the content here. The fact that the statement doesn't make any sense is why we have central banks and why we talk about them and think about them the way we do, because these things simply don't match up to each other. And the other piece of this is the notion that monetary policy can operate as a rule, which can be stated in an objective way, so that it can be treated as if it is simply a fact of the economy. The famous three-equation model that we all know from the textbooks treats the central bank's decision rule as if it had the same sort of ontological status as the Phillips curve, looking output inflation, or the relationship of output to interest rates. Somehow the central bank's decisions have the same kind of objective fact quality as those things. So this really allows central banks to operate at the strategic point of reconciling these two really inconsistent ways of thinking about the economy. And allow the ideology to continue operating even when it's clearly inconsistent with the needs of concrete economic management. So this although there's always a certain kind of instability in this kind of operation of kind of managing contradictions, a decade ago the consensus, as we all know, seemed pretty solid. There was a very clear textbook story that was very widely accepted around monetary policy. And I would sort of describe this as having 5 or 6 key elements. First of all, there was a sharp line between the short run and the long run. In the long run, money is neutral. There's a long run path of output that's guided purely by taste, technology, sort of objective, real supply side constraints. In the short run, money, financial factors, aggregate demand can play a role. And of course, again, that's another way of managing the same contradiction between two inconsistent visions of the economy. Somehow or other, you get from the short run, which is an economy that operates one way, to a long run where it operates in a very different way. Secondly, the goal of policy is simply to stabilize output, employment, and prices. And of course, that follows from the notion that there's some objective, given non-monetary long-run path. The best that policy then can do is simply minimize the short-run deviations from that path. Third, we have this divine coincidence, the idea that stabilizing output is a necessary and sufficient condition for stabilizing inflation, or to put it differently, that there's no trade-off between employment and inflation, that the two potentially distinct goals of macroeconomic policy in practice can be treated as a single goal. And in some way, the divine coincidence also corresponds to the idea that the interest rate, let's say, that achieves these concrete macroeconomic goals of price stability and full employment is also the interest rate that exists in the Walrasian world. It's never quite clear why these things coincide, but there's some notion that they do. So we've got the divine coincidence, which says we may talk about multiple targets, but they're really just one target because the appropriate levels of all of them are going to come at the same level of demand. Fourth, so first was the sharp line between long run and short run. Second is the goal is simply stabilization. Third, the divine coincidence. Fourth, sort of more concretely, operationally, that there is a strong and stable relationship between the policy interest rate that's more or less directly controlled by the central bank and output or other macroeconomic outcomes that we care about. Often in forecasting models, you'll see a semi-elasticity of -1, meaning a 1 point increase in the policy rate will lead in some reasonably short period of time to a 1 point lower level of output. The value doesn't have to be -1, but it has to be reasonably large and it has to be reasonably stable for conventional monetary policy to make sense. And then, finally, the idea that there's or I shouldn't say finally, because I've got one more. Fifth, the idea that a simple policy rule is sufficient to get a good performance on all your macroeconomic goals. And that sort of follows from the notion that you have this divine coincidence and you have a stable relationship with the policy rate to output. So you can write down a very simple rule that will get you the best outcome you could ask for. And then finally, implicitly, that there's a clean separation between monetary policy and the other functions of the central bank, like financial regulation and lender of last resort functions and managing government debt and so on. That we can really separate those off and talk about them in a different context. In a macroeconomics context, we can just focus on monetary policy. Of course, we see this in a graduate textbook where you don't even hear that those other functions of the central bank exist. Central bank is simply setting an interest rate, and that's it. So this notion that you can really separate monetary policy in a strict sense from these other things that the central bank does. Now this consensus is not as old as people sometimes make it out to be. I think you could argue it really only solidified sometime in the 1990s. But by 2007, you know, that's a long enough time, I suppose, in the life of an academic profession that you could treat it as just the way the world is. It's just a fact that the central bank sets an interest rate. The interest rate is used to stabilize output. Stabilizing output also gets your inflation and unemployment goals. And all of this is just done to minimize deviations from a long run path that's completely determined from the supply side. That's what the textbook said in 2007. And I suppose it's still what the textbooks say, but it's not necessarily as much what I think people believe in the concrete world of monetary policy making, or let's say in the editorial pages of the Financial Times. So how did this consensus then break down over the past decade? Well, of course, there was the crisis itself. I don't think the financial crisis was necessarily as big a deal as people sometimes want to make it out to be. You know, it was obviously very exciting. If you were following the news in 2007, you were interested in this stuff. It was great seeing assets losing their value and markets breaking down and banks failing and rich people losing some of their money. It's always very exciting and makes for good stories, and the rich people get very agitated. So we all pay attention to what they're paying attention to. It's one of the perks of being rich. But in the long run, it's not clear to me that it really affected things very much or changed things very much. I think if you thought that mainstream economic theory was doing a good job in 2007, I actually think you would be right not to let the crisis itself move your priors very much. You know, I think actually what was more disturbing in a way was the response to the crisis, the extraordinary actions that central banks found themselves taking in response to the crisis. I think in some ways actually is a bigger challenge to the consensus. But even more than the crisis and the response to it, I think is the experience of the years since then, when central banks have very clearly failed to achieve their macroeconomic goals. I think that really forces a much larger rethink and has forced a much larger rethink. The fact that you've had this very large output gap, even by conventional measures, which I would argue really understate the amount of slack in the economy, the consistent failure to hit the inflation target, which is sort of the reason for existence for central banks in a lot of senses, the failure obviously to get an acceptable unemployment performance in a lot of countries. I think this has really been a much bigger challenge. And again, the actions taken to try to overcome this failure have also been a big challenge. And then there's been a larger sort of confusion about goals. It's been much harder to have this clear, simple story in which hitting an output target, which can simply be defined as minimizing the output gap with this sort of stable long-run growth path, is a sufficient statement of central bank goals. I think central banks, the ECB, the Fed, and other central banks have really been forced to be have a much more open and broader discussion about what they're actually trying to do. And I think that's really still continuing today. And then, you know, kind of coming out of all that is a kind of breaking down of this larger conceptual framework that we use to think about monetary policy and the relation of monetary policy to the financial and monetary system, and then to the rest of the economy. So I want to talk about sort of each of these pieces a bit in turn. In terms of the policy failure, obviously, there's a failure to stabilize activity. If you think that there is a stable long-run growth path, it's very clear that the US economy and most European economies have fallen very far short of that over the past decade. You know, if you look at the United States, and you just take the BEA standard measure of potential output, the cumulative output gap after 2007 is on the order of 25% of GDP. That's enormous. It's far bigger than any previous period since World War II. It's obviously, you know, it's an enormous amount of lost production and lost employment and lost income. It really makes a mockery of any claim that the conventional policy is sufficient to stabilize output, or that we've seen a great moderation, as people used to talk about. I think that one's really been put to rest. Unemployment, again, the performance, you know, now in the US looks okay, not so much in Europe. But the fact that the performance today actually looks pretty good in the US, then in retrospect makes the past performance look much worse. Because if 3.6% unemployment is sustainable, and it seems to be sustainable since we're sustaining it, then that makes the excess unemployment from a few years ago look much larger. It makes it clear that the Fed, you know, if you could have had 3.6% unemployment, if you can have it today, why couldn't you have had in 2011, 12, 13? And that makes the excess unemployment in those years look much larger. And then obviously the failure to hit price level inflation targets is a big problem for central banks everywhere. So this is an obvious failure, and really I think has definitive. Not to mention the fact that the conventional policy tools simply aren't usable. You can't use the federal funds rate as an instrument of policy in an environment of abundant reserves. So you're not going to be able to go back to the status quo. It's literally impossible. The status quo of 2007. Now, this failure, the failure of central banks to achieve their stabilization goals, tends to be expressed in terms of the zero lower bound on the policy rate, which is kind of a funny way of putting it if you think about it for a moment, because it assumes that that one policy rate is the only available tool of policy. It's sort of like, saying the reason you can't, get a screw into a piece of wood with a hammer is because the screw has somehow acquired a property of unhammerableness, when actually the problem is that you're using the wrong tool for the job in the first place. So, but nonetheless, we have this framing in terms of the problem is the zero lower bound. We just need a lower policy rate, which unfortunately we can't get. So if you're going to look at things in those terms, logically, there are three reasons that might be the case. One, the natural or neutral, the full employment, whatever we want to call it, interest rate is lower than it used to be. The average interest rate required to stabilize demand, either at this long run growth path or wherever we think it should be to achieve our other objectives, is lower than it used to be. There's a systematic fall in desired spending relative to income. That's one. Second possible explanation is that although the average hasn't changed, the fluctuations in private demand are larger than they used to be. So the potential were larger than we thought they were. So the potential downward deviations from the average are bigger. And that also, again, is going to at least at times require a much lower policy rate. And the third possibility, the third reason you might need a lower policy rate, again, just working in the conventional framework, is because the effect of the policy rate on output is smaller than you thought it was, or smaller than it used to be. Logically, again, there's no way of saying, is it because the neutral rate is lower or because the impact of changes in the policy rate are on real activity are weaker? It's not, logically either one could be true, or of course some combination. Now the funny thing, as you probably noticed, is that discussions of this stuff really focus almost exclusively on that first possibility. Why, this is secular stagnation, whatever. Why is the neutral rate lower than it used to be? But I think that it's almost impossible to tell a coherent story where that's the only thing that's going on. I think in particular, you really need to revisit the notion that output is strongly sensitive to to changes in the policy rate. And there's a simple exercise I've done, which I'll try to share with you guys in some form after this, that really, I think, brings this home, which is this. Just try to go back and look at the actual economic performance. I did this for the US. I think you could do the same thing for other countries. And take the standard parameters from some kind of forecasting model. Let's say our -1 semi-elasticity of output with respect to the interest rate. Use a fiscal multiplier of 1.5. Why not? People seem to like that. And also you have to look at the trade balance for the US and for a number of other countries in Southern Europe in particular has moved strongly towards balance, from a position of large deficits towards balance. So these low interest rates, big fiscal deficits, and improvement in the trade balance should have had a big positive impact on demand. So then we can sort of back out, if we say, well, here's what actually happened to output. We know, or we believe we know, what these big positive influences were. We can back out what was the fall in demand, the autonomous fall in demand, to produce the substantial fall that we actually saw despite these expansionary influences. And you end up with you can obviously do this exercise in different ways, but you end up with a number on the order of a fall in autonomous demand on the order of 30%, 20 to 30% of GDP between 2000 and 2009. And what are you going to make of that? Well, if that's real, then your problem is a lot bigger than the zero lower bound. Your problem is radically unstable desired private spending. It's really hard to reconcile that with any notion of any sort of rational, optimal process in the private sector. I mean, the conclusion you'd come from that is, the conclusion that Keynes drew, as Jim Crotty talks about in his new book, Keynes Against Capitalism, which is that it's absolutely impossible and irresponsible to leave private investment in the hands of profit-making entities. It's just too radically unstable. In a world of uncertainty, when you let investment be guided by profit expectations, it's going to just behave in this really wild and erratic way. If you believe those numbers. But I find it very hard to believe those numbers. I just don't find any plausible story where autonomous demand fell by 20 or 30% of GDP in less than a decade. And that makes me think that we must have overstated the forces pushing the other way. And in particular, I think we must have overstated the impact of the fall in the policy rates. I think it's very hard to reconcile the actual fall in GDP we observe with the expansionary fiscal policy and the shift towards trade surplus that we observe at the same time. It's very hard to reconcile that with a substantial impact of changes in the policy rate on demand. It requires too big a fall in autonomous demand to get the outcomes that we saw. So I think we have to say that one of the big lessons of the past decade is that even set aside the zero lower bound, the effect of changes in the policy rate are much smaller than we thought, maybe negligible. There's some breakdown in the transmission mechanism. And then we can ask, some interesting questions. Why does the transmission mechanism not work? There's a lot of reasons. Obviously, the zero lower bound, but that, of course, doesn't explain why the substantial fall in interest rates we did see didn't have seemingly any effect. Transmission of the policy rate to other interest rates. This is a very important part of the story. There's a very unfortunate tendency in a lot of theory, and I have to say heterodox as well as mainstream, to have the interest rate as a variable in your model. But there are lots of interest rates and they don't move together. They really don't. If you look at what was happening in 2008, let's say, when the Fed was lowering interest rates to zero, at the same time, a lot of long private rates were spiking. Corporate bond rates went up, by 3-4 points at the same time, and it took quite a few years before they even got back down to their 2007 levels. So the notion that the policy rate is going to be passed on in any sort of straightforward way to the longer rates that actually matter for economic activity is really, it really should be questioned a lot more than it is. And this is, of course, something that Keynes talked about. And in particular, Keynes had a story which I think is very, very useful and relevant in thinking about these questions. And that is the notion of the long interest rate as essentially a conventional phenomenon. The argument, Keynes's argument, is this. If you hold a bond, let's say at 2% interest, a long bond, 10, 20, 30-year bond, and the interest rate, the prevailing interest rate on that class of bond then rises, let's say to 3%, you face a huge capital loss. In that scenario, a capital loss on the order of a third. That's a very, very big risk that you're running in order to collect that 2% interest. As Keynes says, it might be preferable in that situation to take money, which doesn't yield any interest, but also is not subject to capital losses, rather than holding that bond at 2%, if you think that there's a high probability that rates on that bond will be 3% in the future. In other words, what that does is create a dynamic where the rates on long bonds are driven mainly by what market participants expect the rates on long bonds to be in the future, not the expectations hypothesis that you get in the textbook where it's expectations of Fed policy, but the long rates driven by the expectations of the long rates themselves. And these expectations can be substantially self-confirming, because if nobody will hold a long bond at an interest rate of less than 3%, the interest rate won't fall below 3%. And if people observe that the interest rate doesn't fall below 3%, that will confirm their belief that it probably won't fall below 3% in the future and vindicate their decision not to hold it at a lower rate. So there's actually very good reason, once we get into this world of conventional expectations, and that are really actually kind of an almost inevitable feature of markets that are driven by speculation. In other words, long-lived assets where the potential capital gains or losses are substantially larger than the incomes or costs of holding the asset. This is what Keynes called the running cost and the yield of the asset, where the capital gains are larger. Then you get this expectations dynamic, and the expectations are going to tend to be self-confirming and therefore conventional. Whatever people expect it to be, that's what it will be. And I think that's really much more relevant than the liquidity trap in the sense of the ZLB in understanding the failure of monetary policy in the short run. I should say Keynes argues, and I think correctly, this is a much bigger issue when rates are already low. Because when rates are already low, you're looking further ahead, and the potential capital losses if rates rise get larger relative to the yield that you're getting to compensate you for it. So I think this failure of interest rates to transmit to longer rates is a big part of the issue. Another is obviously the existence of credit constraints. For a lot of borrowers, the borrowers whose activity is really dependent on credit conditions, they're much more worried about whether they can borrow, on what terms they can borrow, how much they can borrow, than the interest rate they're paying. I mean, if any of you have bought a house, you'd like to pay a lower interest rate. That's good. But your decision about whether to buy the house or not is going to depend much more on whether the bank will make you a mortgage at all and how much of a mortgage than on the interest rate you can get. So to the extent that it's credit constraints that matter, there's no particular reason to think that changes in interest rates, even if the Fed can influence longer market interest rates, are going to be passed on to actual borrowing behavior. And then we know that a lot of the marginal use of credit may not be real activity, and also, of course, a lot of real activity on the other side is not particularly interest rate sensitive. Econometric evidence, survey-based evidence, business investment decisions are not, don't seem to respond to interest rates very much at all. Businesses, typically, if you ask people how they make investment decisions, they either have a sort of fixed and generally quite high discount rate that they apply, 10% or more, which really doesn't depend on market interest rates, or often they frame it in terms of a payback period, 5 years, 3 years, 1 year. We make an investment if it will pay for itself in 1 year. Prevailing interest rates have nothing to do with it. So housing probably is the only sector of the economy where we could say interest rates, even though, as I said, I think typically credit constraints are more important, but probably there's a relatively greater sensitivity to interest rates in housing, which has some implications I may come back to. And then, of course, there is another impact, which is the impact on current income. When debt is rolled over, or with floating rate debt, higher interest rates subtract from disposable income and may influence spending that way. And that channel for policy is probably, I think, more important than the sort of investment decisions being made at the margin on the basis of the cost of credit that we typically talk about. But in any case, we don't have a reliable transmission, even if you can influence long risky rates, which you can't necessarily. We don't have a reliable transmission from that to real activity. And then there's all the problems with the flattening Phillips curve if we're interested in inflation or employment or other macro variables other than output. Okay, so this fundamental failure of monetary policy to work leads us, first of all, to rethink, I hope, the idea that we can talk about credit in a macro context with a simple interest rate variable, or certainly if we're talking about the transmission of monetary policy, we can have a single interest rate variable. Obviously, in some models, you have to simplify, but you also have to be conscious that you're simplifying and realize what that questions that's going to limit your ability to answer. More broadly, we can't think about monetary policy in this sort of implicit way where you kind of just dump liquidity at the top of the financial system and it filters down to wherever it needs to go in the economy. It finds its way to whoever has the greatest need for it, is willing to pay for it. The financial system, and I really think this is one of the lessons that people have learned over the past decade, is much more partitioned and segmented than that. There are lots of different pieces of it. And lower borrowing costs or more abundant liquidity in one part doesn't necessarily translate into lower borrowing costs or more abundant liquidity somewhere else. It's very possible that large institutions can face abundant available credit at low interest rates while many other households and institutions are still credit constrained. So I think that leads you to the notion that policy, to be effective, has to target specific segments of the market. You have to identify where are the financial bottlenecks, where are the credit constrained units, and target policy specifically there. Now, again, in the crisis itself, that was understood very clearly. The commercial paper market is breaking down. The securitized consumer credit market is breaking down, and we won't get credit, let's say, to households for consumer credit for credit cards and buying stuff on installment, unless we support that specific market. In the crisis, they understood that very clearly. You don't just do that by lowering policy interest rates because there are a bunch of different markets. The housing market continued to get support from the Fed because it was understood that if you don't support mortgage lending specifically, you won't get mortgage lending. It doesn't help to lower interest rates elsewhere. And of course, QE was to some extent a step in this direction because you were targeting the long end directly. QE was crippled by the fact that they didn't announce a price target. They had this sort of implicit supply and demand framework where buying a certain number of bonds was equivalent to announcing a price target. But as I talked about, in a world of conventional long rates, that's not true. You've got to actually have a target. Bank of Japan was willing to be more aggressive with yield curve control and actually announced targets, as the Fed has done historically, and that's had a much bigger impact. But again, even if the impact was small, it was a step towards saying we have to actually target specific segments of financial markets. And I think in the next crisis, we're going to see a lot more of that. So, paradoxically, the takeaway here, I would say, is, that although we have to revise down our beliefs about the ability of central banks to influence macroeconomic outcomes, we have to really be much more skeptical that one policy instrument can achieve full employment, price stability, an acceptable level of output growth. on the other hand, central banks, when they choose to intervene in specific asset markets, are extremely powerful, more powerful maybe than had been acknowledged. The most dramatic instance, of course, we saw in 2011 when sovereign debt markets were breaking down in Southern Europe. And Italy, Spain, Portugal, Ireland, in some cases with rates going above 10%. And it seemed like, and Mario Draghi, well, first of all, because it was ECB, he had to get legal authorization to buy sovereign debt, which they weren't supposed to do. But once he'd done that, and he said those three words, whatever it takes, bang, the rates just collapsed. And now today, they're still the lowest they've ever been historically. In that setting, a central bank has about the same power as God in the Old Testament, who says, let there be light, and there's light. Draghi says, let rates go down, and they go down. He can do that without essentially any constraints. Now, the ability to go from there to real economic activity is a different story, but we have to recognize where the limits are. Okay, so let me switch a little bit away from what we've learned about instruments, about the ability of central banks to do certain things, to the goals, the targets. So I think we can say the divine coincidence, this is something, Blanchard, Olivier Blanchard got a lot of attention for that paper on government debt and new economics of government debt, which is, that was definitely progress from my point of view. But he's also, I think, been very clear that we really have to throw out the idea of a divine coincidence, and a lot of other people, I think, have moved in the same direction, that there's really no convincing story for why we would expect there to be that unemployment, output, and inflation could all be reducible to a single macroeconomic goal. I think it's very clear, that story only made sense when there was a very sharp trade-off between unemployment and inflation. And it's very clear, even if there's some trade-off, it is not sharp enough to reduce them to a single target. It's very clear that you can have very high unemployment and lower but inflation, but not outright deflation. And today in the US, we see very low measured unemployment and basically no uptick in inflation. So there's no sharp trade-off, and therefore they're not reducible to a single target. I think that's very clear. I think the Fed certainly, and I think the ECB in a very different way, have really both acknowledged this fact that you cannot. Now, I think the difference is that the Fed is willing to be much more willing to at least explore the idea of treating low unemployment as a goal, whereas ECB is looking for new excuses to, target high unemployment, even if it doesn't have anything to do with price stability. But in both cases, I think there's an acknowledgement that you can't reduce these multiple targets to a single target. There's no divine coincidence. And even if we thought there was, it's not clear that simply stabilizing output around a trend would get you there. So this is a real problem because we then have to actually talk about multiple goals and trade-offs between them. It creates a political question, which, part of the management of contradictions that is central bank's central role is to take these fundamental questions out of the realm of politics, to suggest that there's no domain of collective choice here. But once you say, well, we can actually get lower unemployment without inflation, then you have to make a choice. How low do we want to go? And what other consequences is that going to have? Now, all these problems get, of course, much worse with hysteresis. Hysteresis, you guys all know, and is, the notion that output gaps can have persistent effects. In the 80s, this concept was developed specifically about labor markets, that basically persistent high unemployment, people become basically unemployable, and so the effective labor force shrinks, or the effective NIRU, non-accelerating inflation rate of unemployment goes up as unemployment is high, because those long-term unemployed aren't really doing anything. They aren't available to employers, so they're not keeping inflation down. More recently, there's been, I think, an extension of this to talk about productivity growth is also in some sense endogenous to demand conditions. I think there's a lot of very strong evidence for that. And also, what I call anti-hysteresis, some people, I don't know if people use other terms for that, but the notion that it's not just large negative demand gaps, it's not just high unemployment that reduce potential output, but positive output gaps. Very low unemployment, a high pressure economy can actually boost potential output. It can bring more people into the labor force, and it can accelerate productivity growth. So once you, and I think the evidence for this is really pretty overwhelming at this point. It's one of these things, it's not like a fringe group of people who are arguing for this. It's Lawrence Summers and Brad DeLong and Blanchard and of course Lawrence Ball, who's been writing about it for a while. So at this point, the evidence, and that again makes these trade-offs much steeper, because you can't just think about policy as stabilizing around a trend. You're influencing the trend you're going to get. Expansionary policy can give you permanently higher output, permanently higher growth. The old saying was, the only trade-off you get is you can get temporarily lower unemployment for permanently higher inflation. But in the world of hysteresis, it's the other way around. You can get permanently higher employment at the cost of temporary inflation. While you're running the economy hot, you'll get high inflation for a while, and labor supply catches up, productivity growth catches up, and inflation comes back down without ever needing to step on the brakes. In a world like that, you really have to say, well, okay, how much inflation will we tolerate for faster growth? How much inflation will we tolerate for a permanent increase in the number of people who can have paid employment? It's not a technical question. There's not a clear, well-defined optimum, and there's not a long run. There's no stable long run, and therefore there's no neutrality of money. There's no point at which we say, okay, now we're back in the Walrasian world where it's all just our endowment of technology and our intertemporal preferences. Money influences go out as far as you can go. So it really makes people have approached it as a sort of technical problem, for measuring potential. And also, of course, it obviously makes the cost of missing on the downside larger if you're not just forgoing output this year and employment this year, but in the future. But it really actually is a profound challenge to the sort of conventional way of thinking about monetary policy and the relationship of the monetary and real sides of the economy. And that's not the only, so hysteresis is a huge problem, but there's another huge problem in terms of targets, in terms of outcomes. And that is the fact that it's very clear that monetary policy affects relative prices. It affects the composition of output, and not just the rate of inflation, not just the overall price level, and not just the level of output. So there's actually several ways in which this sort of relative prices piece comes out. The one that gets talked about the most, of course, is financial stability. That you're having an effect on asset prices, financial asset prices, land prices, housing prices, as well as on the level and price of current output. This goes back, to Minsky's two-price model, where you've got asset prices and price of current output, and those two can vary independently. And in particular, asset prices are more sensitive to liquidity conditions. They're more sensitive to financial conditions. So an environment of abundant liquidity is one where asset prices will be relatively high. An environment of scarce liquidity is one where asset prices will be relatively low compared with current output. And there's no true price. There's no price. Liquidity is a complement, if you like, to long-lived assets. I mean, that actually makes sense. The ability to get something useful in the distant future, if you make a commitment to it, a complement to that is more flexibility to make adjustments along the way if you need to. So you just have to pick, and you'll get a different set of relative prices based on liquidity conditions. So, and that, of course, then gets into this financial stability debate, because maybe we think that asset prices rising too fast is going to create problems, even if current inflation is low. So how do you balance those? But you're changing another. Even more profound set of relative prices is the relative price of labor and capital, profits and wages. We talk about a flat Phillips curve. Changes in output don't affect the price level. Where is that flattening happening? Well, I think it's pretty clear that yes, that would be the argument. Sorry, in answer to Gonzalo's question. Low liquidity, all else equal, scarce credit, is going to lead to lower asset prices. That's the argument. The flattening of the Phillips curve, I think we can argue, it's not happening at the employment to wage step, because the truth is, if you measure unemployment by the official unemployment rate, then you see it seems to have broken down. But if you take something like the employment population ratio and you plot wage gains against them, very nice relationship, just as strong as ever. So the Phillips curve hasn't broken down at that step. Where the Phillips curve is broken down is at the next step, wages to the price level. But that implies that variation in unemployment is not primarily affecting inflation. It's primarily affecting the distribution of output between wages and profits. Because if you raise wage growth and you don't affect price growth, and you're not, and there may be some effect of productivity growth, but it's not going to offset that, presumably, not completely, then you're simply redistributing from capital to labor. And of course, vice versa, when unemployment is high and wage growth is slow, you don't just get deflation or slower inflation growth, you get a redistribution from labor to capital. And there's always been this weird inconsistency in mainstream discourse around this stuff, because of course, when wages are growing rapidly, we're told, oh, this is a sign of macroeconomic imbalances and demand and the economy overheating, and we need a macroeconomic solution. when wages are growing slowly, we're told, oh, this is technology, it's the competition of China, it's a supply side problem, and we need more education, or, get rid of the unions or something. So there's always been an inconsistency, but it's very evident now that it's really hard to avoid the clear evidence that macroeconomic conditions, labor market conditions, monetary conditions still affect wages, but they don't necessarily affect price growth. And that means they're affecting distribution. It's another relative price, if you like, but it's a very profoundly political relative price. We saw a big fall, of course, in the labor share. Obviously, there's a lot of issues in terms of the long run fall, how you measure it. There's really pretty difficult challenges there. But certainly during the recession period, in the immediate aftermath, there was a big fall in the labor share. But there's been some recovery in the labor share. And so if you are targeting unemployment as a central bank, and unemployment does affect wage growth, but it doesn't affect price growth, what you're actually targeting is the labor share. Now, the ECB has been willing to grasp that nettle. They talk now about the non-accelerating wage rate of unemployment rather than the non-real, and they're willing to justify that in terms of competitiveness or other things that have nothing to do with inflation. So they're willing, it seems, to go that extra step and say, well, we don't want wages to grow anyway. I don't think the Fed has really, I've looked, and if you look, you can find a few hints of that, but it's much harder to find. And in fact, if you look at their public statements, they're actually, much more willing to say we would like to see faster wage growth as long as it doesn't lead to inflation. But it's a political question. And I think there's this is really one of the profound ways in which the notion of the Fed or central banks as this sort of independent apolitical bodies is really breaking down now, is the recognition that there's a direct, unavoidable distributional impact from monetary policy decisions. And then, finally, less excitingly, but just in general, there are lots of different sectors of the economy, some of which are more sensitive to monetary conditions, some of them are more sensitive to credit conditions than others. And every time you adjust monetary policy, assuming it's doing anything at all, you're adjusting the composition of output and relative prices between those different sectors. Housing, again, is a clear one. It's clear that to the extent that conventional monetary policy has been effective, a lot of that is operated through the housing market, which means if you want to boost output and you want to, pick up inflation, you've got to produce a housing boom. And if you think the economy is overheating, you've got to produce a housing bust. That's the way monetary policy has worked for a long time. And it's really not clear at all why we would want to be waggling the whole economy from this particular piece. Why do we want to hold it there when we shake it? But again, as long as sort of the outcomes looked acceptable, you could kind of finesse those questions. But the outcomes clearly aren't acceptable now. And so you have to actually acknowledge when we do monetary policy, we're making choices making choices that have long run effects. We're making choices that affect distribution, and we're making choices that affect the composition of output. And then we have to say, okay, what do we want the composition of output to look like? Is supporting owner-occupied housing really such an overwhelming social priority? Or, for instance, would we rather support green investment and decarbonization? Maybe that's the thing where we should be focusing our credit efforts. The Fed continues to support housing lending. Today, they still buy mortgage-backed securities. They're rolling over their portfolio, but that means a lot. A few years ago, a quarter of the new mortgages in the U.S. were ultimately bought by the Fed. Now the proportion is smaller, but it's certainly well above zero. So, you have to make a choice. If that is that what we want, or do we want to be doing something else? You can't avoid it. So I know I need to sort of wind up here. So let me say, where does all this leave us? Well, on a conceptual level, I think we have to make some changes. And again, I think this does apply to a lot of us, a lot of heterodox macroeconomic theory as well as mainstream stuff. I think that we really have to throw out this long run, short run distinction. We really have to throw out the idea that we can have an economy that's, demand determined, that has an important role for money and finance in the short run, but that is a purely real supply side economy in the long run. I don't know. I feel like people are moving in that direction in the heterodox world. But we still, although I should add, and I think this is actually the bigger challenge, we still need some usable idea of supply constraints. I don't think, want to go the full direction some people do and say output is purely demand constrained at all times. I think we need some notion of supply constraints, but we can't frame it in terms of this sort of given long run path of potential output. We need a different way of thinking about supply constraints. I think that's a very interesting intellectual puzzle that somebody should be working on. We have to throw out the neutrality of money. Money is not neutral in the short run. It's not money neutral in the long run. Liquidity is useful. Liquidity is providing something that people need. And when you have more of it, people use it and they make different choices because it's more valuable for some things than for others. It's not in any sense neutral. You know, Minsky, again, has a wonderful late essay called The Non-Neutrality of Money. And I think he's absolutely right. So I think we just have to throw that out. And this is part of, you know, the old Keynesian idea of reconceptualizing the economy, not as a system of real exchange, but as a system of monetary production. Money is fundamental. I think another thing that we have to do is be a little less respectful of the conceptual distinction between monetary policy and the other functions of the central bank. I think we need a conceptual framework where the central bank is trying, more or less successfully, to influence the flow of credit, most fundamentally, and more broadly, financing conditions, balance sheet conditions, asset prices. They're doing that to influence real activity in various ways, the real activity of consumption production. And that description applies to monetary policy, and it applies to lender of last resort operations. It applies to efforts to stabilize the government debt market, all the things the Fed, you know, when you've got this sort of conventional approach where you say we use these tools for these purposes and these tools for those purposes, you can treat them as if they're completely separate, but they really aren't. And I think, again, the crisis, again, to me, the learning experience of the crisis wasn't the crisis itself, but the central bank's response to it, which really made it clear that these are not distinct things. And then, of course, you know, we're also, I think, on a practical level, really moving away from a notion of central banks as independent. You know, in the US, obviously, there's this effort by Trump to get his various cronies on the Fed board. But, you know, in some ways, I think the Fed's defense against that, its response to that in the long run is going to be more consequential and more damaging to this idea of independence, because they are reframing themselves as explicitly political actors. You know, right now they're doing all these Fed Listens events where they go around and invite various people to talk to them about monetary policy. There's one happening next week. I was just looking, where they've got a bunch of labor people coming in and asking them, what does full employment look like for your community or constituency? I mean, this is obviously, on one level, it's an effort to push back against Trump and an effort to build up their own support and demonstrate and legitimate what they're doing. But look, going out and building up a constituency and inviting them to tell you what they want you to be doing, that's sort of the essence of being political. That's what it means to be political. So in its effort to defend itself from Trump, the Fed is really thoroughly politicizing itself, which I should say is, from my point of view, an unambiguously good thing. And the ECB, obviously, in a very different way, has intervened extremely aggressively in a whole range of domestic policy choices in Europe, way beyond the conventional remit of a central bank. I mean, they were obviously the enforcers of everything that was inflicted on Greece, but also in Spain and Italy. You know, it was Trichet, I guess, in those cases, but really pushing very hard for a whole set of liberal reforms, labor market deregulation, privatization, everything. I mean, way beyond anything that a central bank is normally supposed to be concerned with. So again, this is really abandoning the notion of some sort of technical independent body. And I think that's maybe one of the most long-lasting legacies of the crisis in response to it is that this notion of the independent central bank is simply not going to survive. So I think, you know, going forward, we need to have a conception of monetary policy, a conception of the financial system, and an analysis that lets us build on the progress that's been made and have a more, and make sure that we take advantage of the opportunities that come going forward. And I think, you know, in that sense, we should see something like QE, however useless it was, as a step in the right direction, because it's an acknowledgement that there isn't just an interest rate. It's an acknowledgement that the financial system is segmented in partitions and has to be managed. You have to actually think about where the credit constraints are operating, and you can't assume there's just one coherent set of prices such that if you fix this one, all the others fall into line. QE is very explicitly acknowledging it doesn't work that way. If you want long rates to come down, you got to target long rates. And I think we can take that argument and go forward with it and say we actually have an analysis where that makes sense. I think that we also have to make sure in the next crisis situation that we have an argument in place. And I've tried to do this a little bit with some of the Roosevelt stuff that was shared before this conversation, with other stuff I'm working on there. we have an argument in place that says we can't just approach this in terms of saving the financial system. We have to approach it in terms of where do we want credit to go? Where are the financial constraints in our economy that are limiting stuff that really is socially desirable and useful, and how do we overcome those? And I think the real place to be doing that is the Green New Deal, for sure, decarbonization. But we can also talk about postal banking and you know, all the sort of exploitative financial arrangements that poor people get sucked into that the Fed certainly could be trying. I mean, there's a lot of places you can push, but we have to make the conversation about what are the social goals that we want finance to achieve, and not just how do we preserve this system from blowing itself up. And that means, obviously, we have to be making the argument, you can't just dump liquidity at the top of the system. You do have to target, even if you don't care about the socially desirable or otherwise nature of the activity, you have to think about who's credit constrained, or you won't actually be able to influence the outcomes that you want. And we have to recognize, we have to have a vision of the economy that treats money as something real, as something fundamental. It's valuable. It's not just an arbitrary numeraire. It's never neutral, not in the short run, not in the long run, not at all. I think I'll stop there so we can have some questions.
That was great. Thank you so much. I'm sure there's a lot to talk about. There's already 2 questions in the queue. So how we can do this is we have about like 15 minutes, depends on Professor Mason's time. And we already have a few questions out here. So what I'm going to say is that if you can't speak, just like write your name there or write your question. If you can, just write your name and I'll call upon you once we've gone through the questions that are already on queue. So Professor Mason, if you want to like first read them so that for the purpose of the recording, so that we know, if you want, I can read them or you can read them, whichever way you want.
You be the the master ceremonies here.
All right, I'll do it. Okay, so I think this question came from Gonzalo when we were talking about how monetary policy is affecting different sectors in different ways, and therefore the monetary policy should be cognizant of that. And so he's asking what sectors develop the most when monetary policy is solely geared towards controlling inflation with a low wage macro situation.
Yeah, I don't know. I mean, my first answer is it probably depends a lot on the context. I mean, it's clear that housing structures, I mean, obviously very long-lived assets, and also there's a much heavier use of credit. You know, in other sectors of the economy, you have ongoing businesses that can finance a lot of investment out of their retained earnings. Real estate generally operates much more on a credit basis, and the assets are much longer lived. So in general, I would say that abundant liquidity, low interest rates favor housing and other forms of real estate investment. But I think it probably depends a lot on the specific time and place you're talking about. I'm more interested in the general point that it's not, in general, going to be neutral.
Right. Okay, great, thank you. Then Emanuele was asking, when you refer to the conventional nature of the long-term interest rate, do you have in mind any measure the central bank can adopt to influence, and if necessary, to break the prevailing conventions?
Yes, it's very easy. It's very easy. You just have to state a number, that's all. If the Fed says, I mean, they did this during World War II, other central banks have done it, the Bank of Japan has done it more recently. If the Fed says, we have a new target for the 10-year Treasury of 2%, and the 10-year Treasury will go to 2%. It will go to 2%, I promise. If they say it. They just have to say it, but they have to say it. That's the key thing. They can't just buy bonds. Buying bonds doesn't move the price because people don't want to hold bonds at significant lower rates than what they think the long-run rate is. You have to actually tell them what the number is. That's all.
Okay. Great, thank you so much. Then we have a question from Robert Sweeney, who asks, have you considered that the reason for the relative failure of macroeconomic stimulation after the crisis was due to the fact that in the bubble years there was a massive overbuilding of housing relative to need. So when the bubble burst, the new entrants into the housing markets didn't need to have those houses built, but could just buy existing ones for which there was an oversupply of. So new purchases didn't actually lead to any new construction, as Vernon Smith and others have shown that housing investment is typically a much more important driver of the business cycle than business investment. Is the oversupply of real estate a more plausible reason why traditional policies did not have the desired effect in the aftermath of the collapse?
Well, first of all, I would say, I think everything you say is right, and it's completely consistent with what I'm saying. I wouldn't say it's a more plausible reason. I would say it's another way of stating the same reason, which is that there is a relatively small part of the economy that is interest rate sensitive, and in particular sensitive interest rates that are linked to the policy rate. The main one is housing. And that's building policy on a narrow base. It's making policy vulnerable to anything that interrupts, the response of the housing market is going to interrupt the ability of monetary policy to achieve its macro goals. So I think what you said is absolutely correct, and I feel that it's really consistent with what I was saying. Now that said, first of all, the shortfall in housing construction since 2000, not even 7, but 5, I think, is when housing construction peaked, is much bigger than the excess previous. I mean, the housing bust has been much bigger than the boom, certainly in terms of new construction. The fraction of Americans living in owner-occupied housing is much smaller than it was even 20 years ago. There's been not actually necessarily bad, but really striking shift in new construction from single-family to multifamily. The extent there's been a recovery in housing construction has been multifamily. Single-family housing is still tiny compared with what it was before. So I don't think this is a sufficient story because, not just a sort of simple, because the fall in new construction was much larger than the preceding excess if you measure them relative to a trend. And then, of course, the other question you have to ask is, why don't you have purchase anywhere else? Why isn't there nothing else useful in the economy that people could be doing? We could be doing with all that unemployed labor and all those unused machines. Is there nothing useful we could be doing that is constrained by its ability to get financing? I don't think we're in a state of, in some, very high level sense, you could say, well, we can meet human needs with a lot less production than we have and so on. But given the actual urgent crises we have, obviously climate change, but also, poverty and all sorts of unmet needs, all the wonderful things we could be doing, college and universal health care, the notion that there's no other use for abundant credit except for housing it's a profound problem that we should be trying to deal with, and not just saying, well, that's why policy didn't work. Oh, well.
All right, Toby, why don't you go ahead and ask your question?
Yes. Hi, Jason. Can you hear me?
Yes.
Yes. So could you explain again and go a bit more into detail as regards the distributional effects of inflation? Because I feel like this has been a core issue in macroeconomics, but I've never really understood what the mechanisms are. You've pointed at the effects, but how does it work specifically?
Well, let me be clear. I'm not talking about the distributional effects of inflation, which are, could go in various ways. I'm talking about, in a sense, the distributional effects of the absence of inflation. The point is, high output growth leads to higher employment. This relationship is very stable. Oakland's law is very stable. If you have more output, you get more people employed. Really, really quite reliable. 2, more people employed leads to faster wage growth. Not as reliable as the first step, but pretty reliable. Again, if we look at, let's say, the employment population ratio, we plot that against, wage growth measured in an appropriate way. It's a nice tight line. With a nice clear upward slope. So, and there has been some real recovery of the wage share recently. So, and pickup in wage growth. So here's the thing. There's a basic accounting identity at work here. Nominal wage growth in percent terms is identically equal to the sum of inflation plus labor productivity growth plus the wage share. Nominal wage growth, faster nominal wage growth has to show up in some combination of those 3 places. If it's not showing up in inflation, and assuming it's not going 1-for-1 into productivity growth, I think there is some response to productivity growth. I think it seems pretty strong to say it's going 1-for-1 into productivity growth. Then by definition, it's going into the wage share. If businesses raise wages and they don't produce more and they don't raise prices, then the workers are getting more of the output. There's nothing else that can happen there. I think it's I wish that identity was in every introductory textbook. So logically, if you do have some ability to influence employment and wage growth, but those are not passed on to inflation, then what you're actually influencing, probably for the most part, is the labor share. It's really that.
All right, thanks.
Sorry, go ahead. If you have a follow-up, there's a long list already, so maybe you can ask after I go through them if Professor Mason still has time. Gonzalo then asks again, you emphasize non-neutrality. Is it possible to summarize the essence of the argument for neutrality of money?
Well, I mean, one version of it is that money is just a numerator. Money is just a convenient thing for exchanging real goods for other real goods. We have an endowment of labor, of materials, of whatever we've got, which we're exchanging, and money is just a convenient way to do that. So the argument is, and this is an old argument, you can't get taller by changing your measuring stick. If it's just a convenient measurement, then it doesn't affect the real endowment of stuff, so it doesn't affect real outcomes in the long run. That's in some ways the argument is really that there's many more elaborated versions of it. But essentially, if you start from a vision where there is some actual endowment of real resources, labor, productive technologies, then you're left with the no role for money to play. So it has to be neutral.
Right.
I mean, every economics class that you take is gonna tell you some version of this.
Okay, we have another question from Suchitra, who asks, what do you think of cryptocurrency?
I gave a talk on cryptocurrency at a YSI thing last summer, which I really need to write up in some form. But my argument there was cryptocurrency doesn't really change the picture in any interesting way. And my more sophisticated version of that was that if you imagine, I didn't talk about the quantity theory of money, maybe Sheila Dow, who was also at the event where we were both talking about cryptocurrency at the YSI thing last summer, but maybe she'll talk about this more. But if you imagine, if you have a quantity theory of money where there's a fixed stock of high-powered money and the government is the monopoly supplier of it, then if somebody else can produce money, there's something else that can service money, then that looks like a big deal. It's something that might really change the economy. If you have a really strong view of endogenous money, where money is just a set of ledgers kept in the banking system, and the physical currency is just one instrument among many others that lets you make ledger adjustments, well, cryptocurrency is one more way of adjusting the ledgers. So what? It doesn't change the story in any way. So that's my take.
Right. Then David, I think he made a comment. I think it was when you were talking about the housing sector in response to Robert's question. And he says, it's not just housing construction, but with turnover comes increased spending on furniture, appliances, etc. But Q there is domestic versus foreign production. Stimulus comes with large leakages despite increased demand. So he added a comment there. I'm not sure what Gonzalo means here by fire sector, so I'm going to skip that unless Gonzalo wants to write a follow-up. However, okay, I'm going to talk first about Ugri's question since they have not spoken before. I wonder if it's possible for the central bank to increase equities of banks to stimulate the macroeconomy.
Well, this is an interesting question, and there's a lot of debate around this right now. If we think that bank lending is constrained by their capital asset ratios or something like that. Now, this is an argument that's sometimes made against imposing regulation on capital asset ratios, which is where a lot of the regulation of lending now is taking that form. If you're going to regulate capital ratios, the notion is then that might limit lending and discourage real activity. So, of course, then if you can boost their equity, now. The bank capital has nothing to do with the price of their stock officially. So boosting their equity, it's not clear to me that banks are making lending decisions based on their stock price. I'm not even sure how that would work. But there is an argument that boosting bank profits, which does boost their capital, or limiting payouts, which might hurt their stock price, but again would boost their capital. That could boost lending. I think this is the point where it really matters what you think is the kind of linkage between real and financial activity. This is sort of the big argument I'm making, that I don't think that it makes sense to think that there's sort of an economy-wide credit supply which is holding back real activity. I think there are much more sort of specific credit constraints affecting specific kinds of activity, specific sectors, specific kinds of economic units. So that's why I think one of the lessons of the past decade is the sort of top-level policy, like, for instance, boosting bank capital is not likely to have a big effect because it doesn't actually get credit to the specific parts of the economy that are constrained. If banks don't think that certain units are good risks or they're too high cost, having more capital is not going to convince them to lend to those units. And if the units that actually banks would like to be lending more to are not constrained by capital, large corporations, their investment plans are not held back by their ability to borrow. I won't say never. I think you could make an argument in the early 90s. In the early 90s, let's say you had a situation where you really did have an economy-wide credit squeeze. The banks really wouldn't lend because they were concerned about their solvency because of losses in S&L and third world lending, whatever. And then maybe actually boosting bank capital would have had an effect in the early 90s. I think that it's very, very, very hard to tell a story today that looks like that. And incidentally, and maybe I should have brought this up, we have a lot of micro level evidence on this stuff. Gabriel Chodorow-Reich has done some great work, trying, and he has really tried hard to look for evidence of credit constraints on investment. And what he finds is that you can do it for small businesses. Small businesses, you can say, and he's got a very nice method where he links up individual businesses to the banks that were lending to them before the credit crisis on the assumption that there's some kind of relationship. So you get credit on more favorable terms or at lower costs from a bank that you're already borrowing from. And then you can say, well, okay, which of these banks suffered the worst in the crisis? Which of these banks had, the biggest loss of capital, the biggest losses, they had the worst, whatever. And you can say, okay, does this then affect borrowing by the businesses that were previously borrowing from this bank? Does it affect their overall level of borrowing? And the answer is for small businesses, yes, it does. Small businesses can be dependent on particular banks, and when those particular banks are in trouble, those small businesses, in terms of aggregate activity, and particularly in terms of aggregate investment, small businesses are nothing. And even for medium-sized businesses, he just couldn't find any effect at all. And this was a very sophisticated effort by somebody who really wanted to find this, but also was honest enough to report when he didn't. So I think that it's very hard to argue that aggregate macroeconomic output, employment are being held back by a lack of bank capital today.
All right, that's great. I'm looking. I don't think there are any new questions. And if someone still has questions, then do you have maybe 5 minutes so we can?
Yeah, I don't have to run.
Okay, because if no one else has a question, I have a question. I think the story that you tell about the change in monetary policy consensus since the crisis is very convincing. What I'm wondering is how can we apply that story to, say, pre-crisis years as to what the Fed or other central banks were doing to manage the economy? Because arguably, say, the period of the Great Moderation is the period which is supposed to be, I guess, not exactly a divine coincidence when everything works with one policy target, but still, it seems to be considered a time in which policy was effectively stabilizing and achieving its goals in the way it was supposed to achieve its goals. So how do we understand that period pre-crisis in the terms of the rethinking of the consensus that you're thinking about now?
Yeah, I think that's right. I think we need to go back and rethink that. We need to think about, one obvious thing we need to reconsider is how much monetary policy was just tracking some kind of given growth path and how much it was influencing it even then. And I think one really particularly strong case for that is the late 90s. This period of very good economic performance with low unemployment, rapid wage growth, and rapid productivity growth. I think there's a very credible, Gavin Wright, probably if we read him, the political economy of the Cotton South, but he wrote a very nice piece. And I've seen other people make this argument as well, but Gavin Wright made a particularly nice version of it, that we've got sort of cause and effect backwards when we think about the late 90s, that it was low unemployment and rapid wage growth, driven in part by expansionary policy under Greenspan at the Fed, that then were the spur to rapid productivity growth. People obviously venerated Greenspan at the time, but the thing they praised him for was that he correctly predicted or guessed that there was going to be rising productivity growth in any case, and therefore the economy could afford more expansionary policy and more rapid wage growth. But I think there's a very credible argument, and I think it's much more credible now on the evidence of the past decade, that actually it was the strong demand, which in part was due to the choice of Greenspan to follow a more expansionary approach than a lot of other people in the Fed did, that then led to the more rapid productivity growth. I think that's one definite reevaluation we can make.
Okay, thank you. I think we should just end questions here. We have one final question and then we'll end our session for today. Thomas asks, with regard to what you were saying on unemployment measures, do we need a new way to measure what's going on in the labor market? How could we account for job insecurity, etc.?
We definitely do. I think, we have a lot of measures, so we don't necessarily need a new measure. We need to look at some of the other measures we already have. I think, as if you want one headline number, I think employment population ratio is better than the conventional unemployment rate, and also probably better than the other U's, which tend to share a lot of their variation with the headline rate. I think the quit rate is a really good measure in terms of how secure people feel in employment. I think that's a very good measure of labor market conditions. I think in general, looking at flows between employment and non-employment, unemployment outside of labor force, I think are quite informative. And obviously, wage growth. I mean, assuming we have to assume that there is a link, but I think wage growth, we have good reason to think there is a link. So that's telling us definitely something about labor market conditions. But yeah, absolutely. I mean, for sure, the headline unemployment rate, it's not completely uninformative by any means. And I think particularly over short periods of time, when you see a big change in the headline unemployment rate, it is telling you something about changes. But in terms of any sort of absolute measure, I think we definitely do need to do better than that. The last question is literally the subject of my whole talk. You're muted. Deborah, you're
yes,
muted.
yes. Sorry. This is the last question now. Graham's sort of beat me to the punch. So
Graham's question.
He's asking. Sorry, go ahead.
The conventional story is that fiscal policy, in effect, the policy interest, monetary policy can do it all. I mean, the whole, what we've been talking about for the last hour is all the reasons we have. That is the conventional story. You're absolutely right. That's the conventional story, all the textbooks. But what we've been talking about for the last hour is all the evidence, all the reasons we have for thinking that monetary policy, at least conventional monetary policy, limited to a single short-run interest rate, cannot achieve the goals. Both cannot achieve the goals it has set for itself, but also that the goals it has set for itself are not actually coherent because we don't have divine coincidence. Now, I didn't talk about the effectiveness of fiscal policy, but I think that we've had, if anything, a larger movement in the mainstream on that question. I think that the range of economists who would say fiscal multipliers, probably in the range of 1.5. I think it's a very broad range, which would not have been true, in 2007.
Okay, that's great. We're gonna draw the session to a close now. I'm gonna thank our presenter, Professor Joss Mason, for giving a very informative talk and exciting everyone with so many questions. It's really clear. Please remember to join us next week when we have Sheila Dow with us. Yeah, that's about it. Thank you very much for joining us today.
Thank you.
Okay. And the recording of this will be available soon. If you want to read up more about Professor Mason's work on YST, where you found the webinar, there are a few links to his blog and a study that he did at the Roosevelt Institute about the expanding monetary policy toolkit.
Deborah, could I perhaps add a link or two? I think there might.
Yeah, absolutely.
So maybe I'll do that the next day or two, and then people.
Yeah, just send it to me, and we'll make sure that it's shared with everyone.
Great.
Okay, great. Thank you so much.
Thank you.